Imagine walking into a retail store, right? And foot traffic has just completely plummeted, like down by 40%.
Yeah, a ghost town.
Exactly. So you would expect a massive clearance sale, right? Huge red discount signs everywhere, store managers just panicking to clear out their
Of
inventory.
course, yeah, that's just basic economics.
But instead, the owner walks over, crosses out the price tag on a pair of jeans, and actually hikes the price up.
Which is wild.
It is. It's a mathematical impossibility. But that is exactly what just happened in the Q1 2026 property market.
It really is.
I mean, sales volumes crashed to literal pandemic lows, yet private home prices somehow accelerated by a stunning 0.9%.
Yeah, it completely defies traditional market logic. I mean,
Hmm.
when the Urban Redevelopment Authority, the URA, released their initial flash estimates, they actually predicted a very sleepy, modest 0.3% growth.
Right, which sounds totally reasonable.
Exactly. It was a mild adjustment. It made buyers feel like, hey, maybe we finally have some negotiating power here.
But then the final numbers came out.
But then the final revised numbers dropped. Yeah. And the market didn't just inch up, it literally tripled that initial estimate.
Oh, wow. So today on this deep dive, we are pulling back the curtain on this massive curveball.
That's a lot to unpack here.
There really is. Our goal today is to synthesize the latest URA data, some really insightful ERA analyses, and multiple ground-level market reports. We want to help you understand the illusion behind this volume drop.
Because it is an illusion, really.
Right. And we're going to explore why the suburbs, the outside central region, are secretly driving the entire national market right now.
Yeah, the OCR is doing a lot of heavy lifting.
For sure. Plus, we'll break down a shocking land bid on Dunearn Road that essentially mathematically bolts the future price floor in place.
Yeah, understanding the mechanics behind that 0.9% jump is just crucial right now.
Because if you're waiting for a crash, you might be waiting a long time.
Exactly. If you are sitting on the sidelines waiting for the market to crack, the underlying data suggests you might be playing a very frustrating game. The fundamentals holding these prices up are so much deeper than just a few optimistic sellers.
Let's start with this 40% crash illusion because, honestly, the headline numbers look terrifying.
They look really bad on paper, yeah.
Total private home transactions fell to roughly, I think it was 4,041 units. New developer sales dropped 31.5% quarter on quarter.
And resales got hit even harder.
Yeah, resales fell 41.9%. I mean, that is the lowest transaction volume we have seen since Q2 2020, which was literally the middle of the pandemic lockdown.
Right, so when volume drops to 2020 levels, the immediate assumption people make is that demand has completely evaporated.
Like buyers just packed up and went home.
Exactly. People assume the market is failing. But the reality is, this volume drop is heavily distorted by supply constraints and, well, seasonality. It's not a sudden failure of demand at all.
Oh, seasonality. Because of the holidays.
Yeah. First, just consider the calendar. Q1 coincided with the Chinese New Year and the start of Ramadan.
Which naturally compresses the whole transaction timeline, right? Buying a house isn't like buying a coffee. It's not an impulse purchase.
Definitely not.
It requires weeks of viewings, intense negotiations, tons of legal paperwork. So if families just hit pause for 3 or 4 weeks to focus on festive and religious commitments, a huge chunk of the quarter's momentum is simply wiped out.
That's a huge part of it. But you also have to look at the actual physical inventory available to buy.
This stuff on the shelf.
Right. The unsold private home inventory is currently sitting at a 7-quarter low. It's hovering right around 17,029 units. There's simply less product on the shelf right now.
So fewer houses to actually buy.
Exactly.
Yeah.
And because inventory is so incredibly tight, sellers are experiencing this extreme price stickiness.
Price stickiness.
Yeah. They look around, they realize they have almost no competition in their specific district, and they just refuse to lower their asking prices. It creates this massive standoff with value-conscious buyers.
Okay, holding power explains the seller's behavior perfectly. Unlike a retail store with seasonal sweaters that go out of style, real estate in land-scarce Singapore is, well, it's a structurally appreciating asset.
It holds its value, yeah.
But a standoff requires two stubborn sides, right? Just because a seller refuses to lower their price, that doesn't physically force a buyer to pay 0.9% more. Why are buyers capitulating instead of just walking away and renting?
Well, buyers capitulate because life milestones don't just wait for the property cycle to cool down.
Ah, right, life happens.
Yeah, kids need to be enrolled in specific primary schools, couples get married, families outgrow their current space. You can't put your life on hold indefinitely.
That makes sense.
And on top of that, the financial pressure on sellers to liquidate has significantly eased.
How so?
Look at the 3-month SORA rate, right? That's the benchmark most banks use to price their floating home loans. It has actually dropped to 1.14%.
Wait, 1.14%?
Yeah, that is the lowest we've seen since July 2022.
Oh, wow. So the safety net here is really the interest rate. With SOAR dropping to 1.14%, that whole panic of 2023 is just gone.
Completely gone.
Sellers aren't bleeding cash on their monthly mortgage payments anymore, so they have literally zero incentive to offer that clearance sale discount. They just sit on their asking price until a buyer who desperately needs to move into that specific school district by November finally just pays up.
Exactly. And because the broader market is locked in this very patient standoff, the actual price growth is being violently driven by the one segment where buyers absolutely have to move and where developers are actively launching.
The suburbs.
The traditional mass market suburbs, the outside central region, or OCR. It posted the sharpest growth of any tier, surging a staggering 2.2% in a single quarter.
2.2% in one quarter is huge. The suburbs are practically on steroids right now.
They really are.
I mean, based on the reports, the OCR now accounts for more than half of all resale transactions island-wide. And it seems to be entirely driven by these massive new launch benchmarks.
Yeah, the new launches are setting the pace.
Let's actually look at the numbers. Pinery Residences over in Tampines West, it launched and sold 92.5% of its units at an average of $2,546 per square foot.
Which is a huge number for Tampines.
It's crazy. And Tenga Garden Residences sold 98.8% at $2,120 PSF. These are unprecedented numbers for locations that were historically considered, entry-level heartlands.
Yeah, and this phenomena is known in the industry as the benchmark effect.
The benchmark effect. Okay, walk me through that.
So when a major new developer launch enters a suburban neighborhood at, say, $2,500 per square foot, it dramatically alters the psychology of the entire surrounding neighborhood.
Oh, I see.
Yeah, it instantly pulls up the asking prices of older existing resale condos within like a 2-kilometer radius. Resale sellers see these massive crowds at the new launch show flat. They look at that $2,500 PSF price tag, and they immediately adjust their own $1,800 PSF expectations upward.
So it acts almost like a real estate slipstream.
Exactly like a slipstream.
The new $2,500 PSF mega launch is this massive truck cutting through the air, and all the older existing condos are just drafting right behind it. They're getting pulled up in price without having to do any of the heavy lifting.
That is a perfect analogy, yes.
But who actually has the capital to fuel this? I mean, who is paying these prices in the suburbs?
The primary engine here, without a doubt, is the HDB upgrader.
Ah, the upgrader.
Yes. There is a very structural, predictable wave of demand coming from public housing owners who have recently finished their 5-year minimum occupation period, the MOP.
Right.
In 2026 alone, we're expecting roughly 13,500 public flats to hit their MOP.
13,500. That's a massive influx of buyers.
It is, and because HDB resale prices have surged significantly over the last few years, these owners are sitting on massive exit equity. They sell their flats for a serious premium, and then they deploy that cash directly into OCR private homes.
Okay, so let's put ourselves in the shoes of that family looking to upgrade right now. If a suburban condo in Tampines is pushing $2,500 PSF, and the affordability sweet spot for an upgrader is generally hard capped at around $2 million.
Right, the $2 million ceiling.
Are these buyers actually getting the spacious 3-bedroom family home they're dreaming of? Or are developers just shrinking the physical size of the units to keep the total price tag under that ceiling?
The data points heavily towards shrinking footprints, unfortunately.
Oh, you knew it.
Yeah. Developers are acutely aware of that $2 million quantum ceiling because of strict financial regulations, like the total debt servicing ratio, the TDSR, which limits how much a buyer can legally borrow based on their income.
Right. The banks won't let you over-leverage.
Exactly. So to keep the total price mathematically palatable for the bank, while land and construction costs just continue to rise, the developer basically has to shrink the physical size of the unit.
They just chop off square footage.
Pretty much. So a family might be paying top dollar to live in the suburbs, but they are doing it in a highly compact, like 850 square foot, 3-bedroom unit.
Wow, 850 square feet for 3 bedrooms.
Yeah, it is an illusion of affordability. The total price tag fits the bank's calculator, but the price per square foot is breaking historical records.
That is wild. You're paying the exact same total amount you would have 5 years ago, but you are getting significantly fewer floor tiles for your money.
Yep, that's exactly what's happening.
And this massive surge in suburban pricing, it's creating a bizarre psychological ripple effect closer to the city, right? Specifically in the rest of Central Region, the RCR.
The spillover effect, yes.
Because the RCR actually grew by 0.8% in Q1, which doesn't sound crazy until you look at the reports and realize there were 0 new project launches in the RCR during this quarter. None at all.
Right. Without any shiny new showrooms setting new benchmarks there, that 0.8% growth is entirely driven by spillover demand.
How does that work?
Think about the emotional journey of the upgrader we just discussed. They walk into a show flat in the deep suburbs, they see a price tag of $2,500 PS for a tiny unit, and they experience severe sticker shock.
They realize they're paying prime prices for tampons.
Exactly. They do the math and realize they are paying city fringe prices for a suburban location.
So they pivot.
They pivot. They broaden their search radius and move closer to the city because suddenly the RCR looks like an incredible value proposition.
Because if you have to pay $2,500 PSF anyway, why not do it 5 minutes from the downtown core instead of at the end of the MRT line?
Precisely. That pivot is exactly what absorbed the secondary sales at RCR projects like Bloomsbury Residences.
Oh, I saw that. That transacted at 2,549 PSF, right?
Yes. And Pine Tree Hill, which moved units at 2,571 PSF. Buyers who are priced out of their preferred spatial requirements in the OCR are finding comparable per square foot values in the RCR.
That's fascinating.
And that's driving up the baseline of the city fringe without a single new launch needing to open its doors.
But wait, while this private market slipstream is pulling prices up everywhere, the public housing market is flashing a very different, almost contradictory signal.
Yes, the HDB market is behaving very uniquely right now.
The HDB resale index actually saw its first quarterly decline since Q2 of 2019. It dipped slightly by negative 0.1%.
A very slight dip, yes.
Yet paradoxically, the number of million-dollar HDB flats transacted hit an all-time record of 412 units in just 3 months.
That's a huge number.
It is. How do we reconcile a falling index with a record number of million-dollar flats? What does this mean for an HDB owner trying to time their upgrade?
Well, a slight dip in the broader index while premium flats break records indicates a severe market fragmentation.
Fragmentation?
Yes. The era of effortless, broad-based, double-digit price leaps for every single public housing flat is definitely cooling down. The broad market is rebalancing as buyers resist overpaying for standard flats.
So the average flat isn't mooning anymore.
Right. However, rare, well-located, high-floor units with unblocked views are still commanding massive premiums.
The million-dollar one.
Exactly. For an upgrader, this means the window for securing an absolute peak price exit on an average flat is narrowing. As those 13,500 MOP flats flood the market this year, supply will heavily dilute pricing power.
So you can't just sit around and wait anymore.
No, you can no longer assume your standard HDB flat will just infinitely appreciate while you bide your time waiting for private condo prices to drop.
Especially because the raw material of real estate, the literal dirt everything is built on, is practically guaranteeing that the private market price floor isn't coming down anytime soon.
The land costs, yes. That's the ultimate price floor.
Which brings us to the Dunearn Road signal. The government just awarded a government land sale site on Dunearn Road, located in the highly anticipated Bukit Timah Turf City precinct.
It's a very prime location.
Extremely prime. It went to a joint venture between Wing Tai and Metro Holdings at $1,625 per square foot per plot ratio. Now hold on. Per plot ratio is a crucial technical distinction here.
It is very important to understand that.
For anyone trying to do the math with us right now, that doesn't just mean the dirt itself costs $1,625 per square foot, right? It means they are paying that price for every square foot of floor space they are legally allowed to build upward.
Exactly. That distinction is vital. Let's say a developer buys a 10,000 square foot piece of land with a plot ratio of 2.0. That means they are legally allowed to build 20,000 square feet of gross floor area.
Okay.
The $1,625 price tag applies to that 20,000 square feet of buildable space. It is the absolute baseline cost of the raw material before a single brick is laid.
Before architects are paid, before marketing budgets.
Before any of that. Now, the kicker is that this 1,625 PSS AP pay is a massive 15.3% premium over the adjacent plot of land, which was awarded just 12 months earlier at $4,410 PSS.
A 15% escalation in raw material costs in a single year.
Yes.
But the context of how that bid was won is just as important as the price itself, right? Because 6 major developers bid for this site, and the spread, meaning the difference in price between the absolute top bidder and the sixth-place bidder, was less than 10%.
Which is incredibly tight.
Why does a spread that tight matter so much?
Well, a tight spread among 6 multi-billion-dollar developers tells us this 15.3% jump was not just a reckless gamble by one overly optimistic company.
It wasn't a fluke.
Not at all. It represents absolute, calculated market consensus.
Yeah.
All 6 developers looked at their spreadsheets. They analyzed the future of the Carlite Heritage Integrated Vision for the Turf City precinct, and they all independently concluded that the land is fundamentally worth 15% more today than it was last year.
This is literally like a baker buying flour at a 15% markup. There is simply no mathematical way the price of the cake isn't going up next year.
Exactly. The developer's not a charity.
Right.
They operate on fixed profit margins. With land costs secured at that 1,625 PSF baseline, analysts are already running the future numbers.
What are they predicting?
When this project finally launches in, say, the second half of 2027, the felling prices will have to hit somewhere between 3,000 to 3,300 TSF just for the developer to break even and make a standard margin.
$3,300 PSF.
We are seeing a continuous, roughly 5.5% annual growth in government land sale costs across the board. The price floor is being bolted higher and higher before the concrete is even poured.
So if you are waiting for a systemic crash in new launch prices, you are fighting against the actual mathematical reality of fixed land costs.
You'd be fighting a losing battle.
Yeah. Okay, so land costs secure the floor for the mass market and upcoming launches. But there's an entirely different reality playing out at the very top of the property ladder. And this is where the two-speed market becomes incredibly obvious.
That's two-speed market, yes.
While the mass market is dealing with affordability ceilings, TDSR limits, and cautious upgrader standoffs, the core central region, the CCR, rebounded with 0.6% growth.
Right, because the luxury tier operates by a completely different set of rules.
How so?
Well, we saw 188 transactions for luxury deals above $5 million in Q1. That is the highest volume since Q4 of 2023.
Over $5 million.
Yeah. This segment of the market is largely disconnected from domestic mortgage rates or upgrader sweet spots.
They don't care about the SORA rate.
Exactly. It is driven heavily by safe haven wealth. High net worth individuals, both domestic and foreign, are looking at global geopolitical instability, and they are choosing to park their capital in a transparent, stable environment.
Singapore?
Singapore, exactly. They aren't worried about the 1.14% SORA rate. They're worried about capital preservation. So while the broad mass market slows down in transaction volume, the ultra-prime luxury sector is quietly hitting 2-year highs.
Okay, so let me summarize. We have a rock-solid price floor because of land costs. We have a luxury market flying high on safe haven wealth, and an OCR market being pushed up by HDB upgraders.
That's the landscape, yes.
But what happens to the people who are priced out of buying entirely? The people who look at $2,500 PSF in the suburbs and say, I can't do this. They still need a place to live.
They do.
Does this mean they're flooding the rental market and driving rent up again like we saw during the pandemic?
Interestingly, no. The rental market has actually finally exited its intense volatility phase.
Oh, thank goodness.
I know, right? The private rental index rose a very modest 0.3% this quarter after actually dropping 0.5% in the previous quarter. But more importantly, vacancy rates have improved to 6% island-wide.
But let's unpack that 6% vacancy rate, because a few years ago, finding an available unit felt like the Hunger Games.
It was incredibly stressful for tenants.
During the pandemic, construction delays meant no new supply was entering the market, causing intense tenant bidding wars. I remember people offering above asking price just to secure a basic apartment.
Yeah, that dynamic has fundamentally shifted now. We are currently seeing a massive wave of temporary occupation permits, or TOPs, being issued.
Projects are finally finishing.
Exactly. Projects that were delayed are finally completing, handing over keys, and flooding the rental market with fresh inventory.
More supply to meet the demand?
Yes. This new supply absorbs the demand from those who are priced out of buying, completely diffusing those bidding wars. Healthy leasing demand is finally matching up with a tighter stock of completed homes.
So the crazy spikes are over.
The wild double-digit rent spikes are behind us, yeah, replaced by moderate sustainable stabilization. In fact, while the central areas stabilize, OCR rental prices are actually seeing slight gains as tenants themselves pivot to the suburbs in search of value.
It is a market full of cross-currents.
Yes.
Seriously. We have slowing overall sales volume but accelerating price benchmarks in the suburbs.
Right.
a cooling HDB index, but record million-dollar flats.
It's complex, for sure.
Let's distill all these signals down to the core takeaway for everyone listening.
Okay, the core takeaway is this. Look past the headline of a 40% transaction crash. That volume drop is an illusion masking a structurally tight market. Sellers refuse to drop prices because their interest rate pressure has eased, and buyers continue to pay premiums because life milestones dictate their timelines.
The definitive story of Q1 2026 is that the price floor in Singapore's private market is firmly secured.
Rock solid.
It is being pushed up from the bottom by suburban benchmarks breaking $2,500 PSF, fueled by a wave of HDB exit equity. And it is being pulled up from the top by relentless land cost escalations, perfectly illustrated by that 15% jump at Dunearn Road. The math simply does not support a massive price correction.
It really doesn't. And this actually brings us to a fascinating structural shift to ponder.
Okay, let's hear it.
If we look at the trajectory of these trends leading into 2030, the very definitions we use to understand real estate are being rewritten. Think about the traditional concept of the suburb.
Okay.
Historically, the OCR was defined by compromise, right? You traded a central location for affordability and more space.
Exactly. You live further out, you get a bigger place for less money.
But today, as OCR mega developments and Campeens and Tanga command $2,500 FCSF and feature massive integrated lifestyle hubs, they no longer function like traditional suburbs. They are evolving into premium mini-cities.
Premium mini-cities, I like that. And at the exact same time, the government is fundamentally changing how prime city center real estate works.
Yes, look at the new public housing models.
Right. The upcoming Pearls Hill BTO, right in the city center, comes with strict new lease restrictions, a 10-year minimum occupation period, and subsidy clawbacks. It is a completely different asset class compared to older central flats like the Pinnacle at Duxton.
Because the Pinnacle could just be flipped for massive unencumbered profits.
Exactly.
So if the suburbs now cost as much as the city fringe, and brand new central public flats are heavily restricted from being traded freely on the open market, we are arguably witnessing the death of the traditional suburb.
The death of the suburb, that is heavy.
It is. The old real estate adage of location, location, location is literally shifting beneath our feet. What will a prime location actually mean in 2030 when the heartlands are priced like luxury real estate and the city center is locked down by policy?
That completely changes the entire calculus of where and why we buy. When the flash estimate says drizzle, but the underlying data reveals a downpour of structural shifts, you really have to rethink your entire forecast.
You really do.
Take a close look at the mechanics of your own property journey, because the ground rules have officially changed. Thanks for joining us, and we will see you on the next deep dive.